What if I told you that without AI spending, the US economy would probably already be in a recession? And that at the same time, even the CEO of OpenAI says we're in an AI bubble? And those warnings aren't from random internet pessimists. They're from Deutsche Bank and from Sam Altman himself. So here's the problem. Most index investors today are quietly betting a huge chunk of their retirement on that same AI story. If this bubble really bursts, your boring index fund will not be boring at all. In this video, I'll break down, in simple terms, how the AI bubble is being built, what could make it pop, and what I'm personally doing with my own investments. This is not financial advice. It's a look at the risks behind today's market. Let's start with how concentrated this has become. Right now, just a handful of mega-cap tech companies, the so-called Magnificent Seven, make up roughly a third of the entire S&P 500 by market value, around 35 to 37%. The top 10 companies in the index now control about 39% of the S&P 500's market cap. That's way above the concentration level at the peak of the dot-com bubble in 1999 to 2000, when the top 10 were only around 27%. So we have more concentration today than we had right before the last famous tech bubble popped. Now, look at Nvidia. Nvidia has become the core way the market bets on AI. Estimates say it controls around 90% of the AI chip market. In its most recent quarter, Nvidia reported $57 billion in revenue, and about $51 billion of that was from data centers, basically AI infrastructure. Some analysts are already talking about Nvidia's data center revenue potentially tripling again in the next few years, implying that the company could be worth $10 to $20 trillion someday if things go perfectly. The key idea: stock prices already assume AI becomes one of the most profitable technologies in history. They are priced as if it will be massive and will be monetized. Next question: what are we actually building with all this money? Big tech is on a spending spree. In 2025 alone, Amazon, Meta, Microsoft, and Google together are expected to spend around $320 billion on capital expenditures, mostly on AI infrastructure, data centers, GPU farms, networking gear. That's more than the entire GDP of countries like Finland. All of that has to be powered. The International Energy Agency says data center electricity use could double by 2030, reaching around 3% of all power used on Earth. Analysts warn that AI alone could grow from about 5 to 15% of data center power used today to 35 to 50% by 2030. Translated into normal language, we're rebuilding major parts of the power grid so your chatbot can write emails faster. This bubble is tied to real-world commitments: new power plants, new transmission lines, and massive concrete data center boxes full of GPUs that can't easily be undone if the returns don't show up. Now let's look at how the money actually flows. At the center, you have the AI chip makers, cloud providers, and AI labs. A simplified version of the loop looks like this. A chip company raises money from investors because everyone believes AI is the future. It sells GPUs to cloud providers. Cloud providers sign multi-year contracts with AI labs. AI labs get private funding at sky-high valuations and commit billions back to the same cloud providers. The cloud providers, seeing all that demand, order even more chips from the chip company. From the outside, it looks like huge revenue growth everywhere. But a lot of that money is being passed around the same circle, often financed by debt or by selling more stock. Deutsche Bank has basically said the quiet part out loud. Without this explosion in AI capital spending, the US would likely already be in a recession. AI spending is now doing two things at the same time. It makes a few big companies look like they're growing faster than they really are, and it boosts GDP, making the whole economy look stronger than it actually is. That's how a bubble gets huge. No one wants to slow it down, because if AI spending drops, it doesn't just hurt tech investors, it could reveal how weak the rest of the economy is. Let's talk about what bursting could realistically look like. This doesn't automatically mean AI is worthless. The internet wasn't worthless in 2000 either. It just meant that prices had run way ahead of reality. There are a few ways this can break. First, spending fatigue. Deutsche Bank is already warning that AI capex can't keep growing at this pace forever. Eventually, CFOs start asking the simplest question in business: where's the profit? And if companies start cutting back, growth at AI-exposed firms can slow very quickly, because a lot of today's revenue is driven by upfront investment, not stable long-term profit. Second, the grid and regulatory wall. If data center power demand keeps exploding and runs into real-world limits, higher electricity prices, delayed grid upgrades, or political pushback over emissions, governments can step in and slow or cap expansion. Third, a sentiment snap. Sam Altman openly says we're in an AI bubble, and investors like Ray Dalio and Jamie Dimon have compared parts of this boom to the dot-com era, real technology, but a lot of capital that will be wasted and eventually wiped out. When investors suddenly say, "Show me real profits," highly valued stocks can re-rate fast and brutally. We've seen this before. In 2000, the Nasdaq fell nearly 80% from peak to trough, even though the internet later became the backbone of the global economy. And if something similar happens now, it won't just hit AI stocks. Today, the Magnificent Seven make up over one-third of the entire S&P 500, and the top 10 names are almost 40%. So a big drawdown in AI-linked megacaps would pull down the whole index, including the retirement accounts and index funds of people who think they're diversified. So the risk is not just some startup investors lose money. The risk is the main engine holding up the US stock market and GDP is one story that might not deliver as fast as it's priced. So what do we do with all of this if we're trying to be sane, long-term investors? Here's how I'm thinking about it. First, I want to understand my real exposure. If I own broad US index funds, I know that a big slice of my money is effectively a leveraged bet on AI, whether I like it or not. Second, I don't want my portfolio to live or die based on one story. So I'm careful not to go all in on the same set of AI megacaps on top of my index funds. If my index already gives me 30 to 40% exposure to those names, I don't need to double up with individual positions in all of them. Third, I care more about cash flow than narrative. I prefer businesses that actually generate free cash flow today across different sectors and geographies, rather than tiny companies whose entire valuation is, "We'll monetize AI later." Fourth, I accept that I can't time the bubble. Bubbles often go higher and last longer than anyone expects. So instead of trying to guess the top, I focus on dollar cost averaging into diversified funds, keeping some cash or short-term bonds as dry powder, making sure I'm emotionally and financially okay if stocks go sideways or down for a few years while earnings catch up. Finally, I remind myself of the dot-com lesson. The technology can be life-changing, while the stocks tied to that technology can still crash 50 to 80% before the survivors emerge. I want to own the future, but I don't want my entire financial life to depend on one crowded trade staying fashionable forever. If this helped you see the AI boom a little more clearly, subscribe for more simple breakdowns of what's actually happening in the markets. Thanks for watching, and I'll see you in the next one.